jobs, the U.S. stocks fell overnight and they slipped in trade, weighed down by weak data from Asia as well as economic trouble in Europe. Monday's decline now comes as quarterly earnings reports get underway. Now, this is the third day of decline in a row for the S&P 500 index. Alcoa's shares, they rose about 2% in extended trading after the largest U.S. aluminum company posted its earnings. Investors are anxious to see what impact weak demand in Europe and slowing growth in Asia have on corporate America. In economic news, of course, the machinery orders in Japan fell at a record pace in the month of May, while inflation in China has now eased to a 29-month low. And this suggests falling demand from Europe and the United States for exports. Now, the overseas data comes on the heels of Friday's disappointing U.S. jobs data. So, which is why on closing bell, the Dow knocked down a good 36 points. The S&P 500 index was marginally in the red, and the Nasdaq Composite as well was down by about 6 points or so. Now, three top Federal Reserve policymakers on Monday laid the groundwork for a third round of bond purchases. Fed officials said that U.S. recovery was weak and unemployment was far too high. San Francisco, Richmond and Chicago Federal Reserve Bank presidents all are in support of the move. The Fed has already undertaken two unprecedented rounds of quantitative easing, buying $2.3 billion, or rather $1 trillion, I stand corrected, in long-term securities to push down borrowing costs. Now, the Fed next meets to discuss its policy on July 31st and then on September 12th.
Check on Asian markets. What do we have there? Asian markets, by and large, they are directionless. Hong Kong on your screen up 22 points. Japan is up 23 points. Check on commodities. Commodity markets, at least last night, they were slightly volatile. Currency markets, however, are telling us a different story. Like I mentioned, the euro has plunged to a fresh two-year low against the dollar, which means we've gone back to pre-EU summit levels when it comes to currency, and I've always maintained that more than equities, currency is often the lead indicator. You want to check on global volatility and the dollar index. Dollar index is now firmly fixed above 83, and that's global volatility for you. Not a big spike, but in last 4 or 5 trading sessions, the global volatility, which is CBOE VIX, has quickly appreciated from levels of about 14.5 to current levels of about 18. So more than absolute fear, I think there is a degree of nervousness, but I would say there is some degree of caution as well ahead of that important EU Finance Minister Summit. Let me now bring on board Ketal Sakpara, Director Research with the EQC Funds, who joins us live from New York. Ketal, good morning. Thank you for joining us. Ketal, how would you characterize the market environment? The fact that last night Italian, French and German bond auctions have registered a negative yield. What does that indicate?
Hi, good morning, Nikunj. Yes, absolutely. Negative real yields is something which shows that investors are extremely worried about their return off capital rather than return on capital. So it's a behavior which is in line with what is going on in Europe, because, I mean, within the Euro region, if you consider the different countries of which you can buy debt, Germany and France seem to be on the safest side. Everybody else, Italy, Spain, even if they offer 6 to 7%, why would you want to risk your basic capital for 6% dividend yield or 7% dividend yield for that matter? So if you are a private investor and if you are not forced by the government like the banks in the Euro region are, then I don't think there is a good reason to buy any of those countries' debt at 7% dividend yield. You would at least want north of 15 to 20% interest rate yield. For buying such risky debt. So I think Germany and France are your only bet right now.
Ketal, hi, morning. Three policymakers in the U.S. have been vying for further quantitative easing and pretty much laid the groundwork as well for further round of bond purchases. Do you think it is an inevitability considering the weakening macros across Asia as well as Europe?
I think the Fed, further monetary easing from the Fed will depend on how the markets react. As long as you are in the 1300 range on the S&P, I think 1350 right now, I don't see a good reason why the Fed would intervene. If the S&P falls below 1200, I think in that case, the probability of the Fed intervening increases drastically. Just because at that point, any action from the Fed, one, would calm down the markets, and two, it would give a big boost to the market. So it would, it would serve dual purpose. Right now, when the S&P is in the 1350, 1360 range, and if the Fed comes up with further quantitative easing, the markets will get a 2-day bump and forget all about it. So I think that's the only time I see further quantitative easing coming into the picture from the Fed.
Ketul, very quickly, what explains the weakness in euro? The fact that euro has plunged to a fresh 2-year low against the dollar, and we've pretty much gone back to the pre-EU summit levels. What does that indicate?
I think euro, it's a straightforward short versus the dollar, according in my mind. And the reasons are very simple. All the euro problems that we have been discussing for the last couple of years, they fall down to 3 solutions, and I call it the GDP solution. G is you grow out of it, which we can leave aside for now. That's not happening. D is, you default, which again, the EU doesn't want to go that path so far. They have gone through some soft default with Greece, but they don't want to go through a hard, real default. So the only real option left is print, so the P part. And as long as you are convinced that the euro region will keep printing euros, you can see how the euro could weaken, further as they print more and more. And I think that's the key reason why everybody is piling up on shorting the euro, and I see that trend to continue till they come up, with the G part, which is the growth part, which can solve the debt problem.